Good morning. My name is Aditya Pattanaik. I am an investment advisor at Sprott. The following excerpts are from a discussion I recorded with Rick Rule on the 24th of January 2024. The focus of our discussion today, Rick, is really centered around the topic of thinking about the price of a commodity once it is above the incentive price for the sector. You've often talked about how high prices are the cure for high prices in commodities, but high prices are also usually accompanied with a compelling narrative that there is an imbalance between supply and demand in that commodity, and often also there is no clear line of sight to a resolution of that imbalance. I'm hearing this a lot in the uranium market today, and I thought it would be interesting for us to talk about the specific supply and demand drivers that are at play in the uranium market that may or may not be different in terms of sustaining these higher prices for longer than in other commodities. I have several charts that would be useful to share. So let me share my screen with you first. Okay, well, so if you can see them, then I'd like to start the discussion here. By comparing the incentive price for the sector with what we're seeing in the uranium market today in terms of both spot and long-term prices. When we look at the production cost curve for the uranium producers, most of them reside below $70 per pound. Now, if you look at the long-term price today, and this is something I pulled from Cameco's website, the long-term contracting price is very close to that $70 mark. The spot price, on the other hand, has completely diverged from that long-term price and is trading well above $100 today. So on the one hand, the price is at the top end of that cost curve, but on the other hand, we're still very early in the cycle from a contracting point of view. And there are also unique dynamics at play in the spot market being driven by financial intermediaries and fund flows. So do you see the spot and term prices being disconnected from the incentive prices for an extended period of time based on these supply and demand dynamics in the market today?
Indeed, I do. It's important to note in the first instance that in the last 4 years, the spot market, while it's important to the uranium narrative, is less important to the uranium market, which is to say more and more volume today is taking place on the term market. So while the spot market is a point of reference, only about 20 or 25% of the material that trades on the spot market, a market share that likely continues to decrease. The more important number is beginning to be the term market. It's important to understand, I think, too, that the recent increase in the price that we've seen in both the spot and the term market, but particularly in the spot market, will not, in the near term, materially increase production. One of the things you learn in capital-intensive cyclical businesses is that while markets work, which is to say that high prices encourage conservation and incent production, the permitting timelines and the construction timelines mean that increases in price that you see now result in increasing production in 5 years, in 7 years, in 10 years. It is true, Aditya, that in the uranium business, the period of low prices was extreme enough that a reasonable bit of economic production was shut in on a hot stop basis, meaning that it could be returned to production fairly quickly. Most of that production was the property of either Kazatomprom or Cameco. Both of those companies have stated that they will only return the hot stopped production to production when they have enough of that production contracted in the term market with investment credit quality counterparties that they can be assured of a reasonable return on capital employed. That suggests to me that there will be hot stop production, perhaps as much as 20 million pounds annually, returned to production beginning in the end of 2024 through 2025 into 2026. What I really like about uranium is the demand inelasticity relative to price. It doesn't make a hell of a lot of difference to a reactor if the price of uranium is $70 a pound or $100 a pound. Of course, they would rather pay less than more. But when you look at the fact that the feed inputs in terms of the total cost stack to produce a watt of energy is 5 or so percent of the total cost, there is lots of room for sustained higher prices. You know, if you are operating aditya, a peaking plant, a natural gas-fired peaking plant, the fuel cost may be 70% of the cost of producing electricity, whereas in a nuclear plant, it's more like 5 or 5.5%. That means that the power industry is much more natural gas price sensitive. Now, natural gas is cheap, so in the near term, they're incented towards natural gas. But in the uranium business, the cost of uranium becomes much less important than access to supply.
One of the things that has always struck me about the supply and demand forecasts for the sector, and this is not based on anything beyond the existing nuclear fleet and the 58 reactors under construction, is that you have this very significant deficit that develops towards the latter part of this decade. And so when you're thinking about the price, the commodity relative to the incentive price, does this essentially guarantee that these prices are going to stay a lot higher than the cost curve for the entire sector, in your opinion?
I don't see, absent the next gen deposit, any deposits which could be brought into production prior to 2030 that will increase supply. Yes, you will see 15 to 20 million pounds return to production from Inkai and Cameco, and you'll see that occur, I think, within the 24-month time frame. Beyond that, there are some fairly small deposits, primarily in the United States, in Texas and Wyoming, in situ deposits that'll return to production, which will add another 4 to 5 million pounds. On the other side, the industry, both the utility industry and the nuclear and the uranium industry, had anticipated that excess of demand over new mine supply that you see in your chart would be covered from existing inventories. The existing inventories, however, suffered, if that's the right phrase, a precipitous decline. Firstly, your employer, my former employer, Sprott, went and bought 46 million pounds. Those pounds went to supply heaven. Secondly, the Japanese have now begun in earnest the pace of Japanese restarts, which means that inventories which the industry believed exceeded 60 million pounds were no longer available for sale in the spot market, but rather constitutes inventory held for utilization by the Japanese. So the industry's expectation that the supply deficit would be met by existing inventories suddenly has become extremely suspect. And I think it's that suspicion itself which took the uranium price in the spot market from $40 to over $100.
When I looked at this 30-year chart based on what are clearly oversimplified supply and demand curves, is that at least from the late 80s to present day, the only two spikes that we have seen in uranium prices, one in 2008 corresponded with a supply shock when Cameco had to shut down Cigar Lake and McArthur River because of flooding. And then the more recent spike has to a large extent coincided with a lot of enthusiasm in the spot market, in addition to all of the things that you were talking about with regards to contracting starting up again. So based on the predictable demand growth from nuclear reactors I'm still hearing that you feel that these price moves are sustainable this time around for the sector.
Provided, Aditya, that three events don't occur, which is to say, a broader war where there would be instability in new plant construction. Two, the avoidance of a market crash around emerging and frontier markets. And I still consider China to be an emerging market. And three, that we don't have a broad enough recession in the West that the availability of finance for new nuclear plants or the demand for electricity around export-oriented industries doesn't exist. If we continue with the world as we see it, my suspicion is that the growth in demand for nuclear power will be inexorable. Because demand for electricity continues, not merely for things like electric vehicles, but as an example, for data centers around computing. The big rage right now, of course, is this, AI. The power, the electrical demands associated with artificial intelligence are incredible. And in fact, the power demands around the whole data processing industry are growing very fast, and I would suggest are, frankly, inexorable. But in addition to that, and we've talked about this before, Aditya, in your discussions around uranium, there's still 1 billion people on Earth, including 120 million in the country of your birth, that have no access to primary electricity. There are another 2 billion people on Earth that have access to only intermittent or unaffordable electricity. It isn't merely getting electricity to those people, although that'll be an important consumer of electricity, but rather, in addition to that, the increased amount of electricity that they will use once it has been delivered to them that will make a difference. And increasingly in parts of the world where consumers and politicians can afford to care, people would prefer that electricity not come from the burning of fossil fuels. And so what you're seeing is, in addition to an inexorable demand for increasing amounts of baseload power, there is a demand for baseload power increases that are carbon neutral. And those two requirements, baseload and carbon neutral, come down to one real functional answer, which is uranium. This isn't to suggest that people can't invest in wind or they can't invest in solar, or that those aren't, in the right circumstances, good places to invest. But if you care about reducing carbon loading, the real equation comes down to, can you substitute nuclear power for coal? That's the whole discussion. The Chinese are taking the view right now, as are the Indians, that they need both. The largest year on record for coal demand, despite the fact that the World Economic Forum doesn't like it, was 2023. Looking longer term, and both the Chinese and the Indians are responding to this, both of those countries and many frontier market and emerging market countries understand the needs that they have to reduce particulate pollution from coal burning, but they see themselves having no near-term alternative. And as a consequence of that, around the world in frontier and emerging markets, those societies that can afford to add nuclear capacity are doing just that.
Yeah, one thing that really struck me when I was looking at the 58 reactors under construction is that it's not concentrated in a few names. It's the entire BRICS side of the world, which is exploring nuclear or increasing their current percentage of nuclear energy. But the other thing that struck me was that of the 58 reactors, China is building 23 and Russia is involved with 19.
Right.
Reactors. So a lot of the actual technology is in the hands of two players. The first question, and I think this is an important question because of what is happening in China today. We're seeing the influence of what is happening in China right now on a whole bunch of different commodities. Uranium so far has been immune. And given the state-sponsored nature of the sector, do you see the sector being immune based on its long-term nature, or do you see funding drying up in the near term?
That's a question that's bigger than I am. I know the people at Fosun, and hence I know the people at China General Nuclear fairly well. And I would say that currently the state is very much in favor of nuclear. The Chinese economy itself is sort of opaque. And I think the will is there to fund it. I think the need is there to fund it. I'm concerned about a society where 10,000 people make the decisions for 1.4 billion people. I'm concerned about the lack of feedback mechanism in a statist country rather than in a market economy. So I do have some nervousness in China that there would be grand mistakes at the state level that would reduce their ability to fund. I think it's certainly true as well that the Chinese surplus has as much to do with the Western world consumer as it has to do with anything else. And I think if you saw a broad-based recession in the West that reduced the ability of Europeans and Americans to import consumer goods from China, that China's ability to fund would decline. I'm not smart enough, Aditya, to give you any mathematical sense of the probability of that occurring. What is very clear to me is that the preponderance of construction that you see in the countries that you see it in is partially a function of those countries' need for generating capacity of any type as quickly as they can, but also as a consequence of state-sponsored economies where permitting is less of an issue. The same sort of plant, modern plant, that you can build in China for $6 or $7 billion and you can permit in a year and a half or 2 years would cost you $15 to $20 billion in the United States and would take you 20 years to permit. So I think in the near term, what you're going to see is the growth in generating capacity will occur, first of all, in countries that have a more urgent need for that, the United States having perhaps the least urgent need in the world, and also companies where the permitting regime is such that it's measured in months rather than years. I take with interest your note about the technology around nuclear being resident in China and Russia. I would say that the recent experiences in China and Russia, the Russians with regards to reprocessing and refining, the Chinese with regards to plant construction, it's generally believed within the power generating world that the best technology around that still resides in the West. Formerly in Japan, with Hitachi and Itochu in the form of Westinghouse. Westinghouse, of course, now being owned by Cameco and Brookfield. So to the extent that there is a competitive market on a global basis for the construction of enrichment, re-enrichment, and nuclear power plants, I think what you'll find is that North American technologies will continue to be employed in these markets, although perhaps not in Russia and China.
One of the things that we started talking about in December 2020 was Russian sanctions. And then we had a war, and then that discussion came up again. And now the discussion has come up yet again. There's a bill in the Senate where they are talking about banning Russian supplies throughout the nuclear fuel chain. So do you see this materializing at any point, given the significance of Russia in the nuclear fuel industry?
It impacts sentiment. It's irrelevant in the market. Uranium is truly fungible. First of all, last year, there were hostilities, I think it's fair to say, between the United States and Russia. And American imports of Russian uranium products doubled, which will show you how fungible it is. Let's say for a second, however, that we decided to ban Russian imports. How much attention do you think that Modi would pay? Or how much attention do you think that Xi would pay? What would happen, in effect, is that Australian exports and Canadian exports, which currently go to Russia and India, would be backed out by Russian exports, and Russian exports to the United States would be backed out by additional Canadian and Australian production. From a sentiment point of view, it's very important. From a reality point of view, it is absolutely unimportant. One thing that will change is that the Russians were allowed politically to dominate the refining and re-enrichment business as a reward to them for agreeing to downblend their warheads. What you will see now is that for strategic reasons, re-enrichment capacity and refining capacity will be added around the world that isn't subject to the whims of the Russians. That will be the only change.
Now we're getting to the part of this discussion of making money in the sector. This is where I get a lot of questions as well from clients who are in the space about whether they should continue to hold on through the ride ahead in uranium prices. So when you look at the spot price today and when you look at the term price, the spot price is above 100 and the term price is close to 70. From a valuation perspective, at what price do you essentially exit the sector?
I think you have to stop looking at the spot price, unfortunately, because it's a floating abstraction. In order to understand the realized price that Cameco is going to realize for the uranium, you need to understand that most of their uranium isn't sold at spot. So you're going to need to determine as best you can, and I suspect that they will begin to report this, the minimum term prices that they can expect on a going forward basis and the rolling off of prior contracts. Note that with the spot price of uranium at $100, Cameco is still selling a fair bit of production in the term market at prices less than $40 per pound. I can't emphasize enough that while the spot market is the easiest statistic to see, it's increasingly an irrelevancy, and investors are going to need to dig way, way, way deeper. What is important going forward is going to be hard to ascertain, which is to say the expected minimum level of revenue per unit of production, which is a function both of the floor price and the escalators in the contracts going forward, and also the pace at which the existing contracts roll off. Now, this is only important for the companies that actually produce uranium. There's a very few of those. BHP, for whom uranium is unimportant, but they're important to uranium, Kazatomprom, and Cameco. For the investors who are interested in the development stage uranium companies, I would urge you to pay very little attention to the spot price at all. There is one company, UEC, which has suggested that they're going to remain unhedged. Investors like this because it gives them uncapped upside, but I would suggest exposes them to some downside too. From the point of view of investors or speculators who are clients of yours, Aditya, once you come down from Kazatomprom and Cameco, you need to concern yourself much more with the term market going forward. Your companies, because they don't produce any uranium yet, don't have legacy term contracts to deal with. And increasingly, because of the irrelevancy of the term of the spot market in terms of pricing settlements in the uranium business, what's really going to matter is the company's ability to enter into longer term markets with credit-worthy counterparties. It's important to note credit-worthy counterparties. Having a term contract with a uranium trader is of much less use than having a long-term contract with an investment-grade counterparty, an Ontario company, an Ontario Hydro, a Duke Power, a Southern Company, a China General Nuclear, a Tokyo Electric Power. Those are the contracts that'll make a difference to the banks that finance power plant construction and to the equity analysts that take the time to construct intelligent financial models around development stage uranium companies.
One of the things that has struck me about valuations in the development stage companies is that a lot of them are trading at 1x net asset value of their base case. This is pre-financing, pre-construction. So they've essentially moved through the Lassonde curve in terms of valuations based on their own economic studies, based on what has happened with the price of uranium.
So when you look at those studies, I think it's important to normalize them. The more responsible companies give you base cases at different interest rate assumptions and at different uranium prices. I've seen base cases for developers at $50. I've seen base cases for developers at $70, and I recently saw a base case at $90. It's also important to understand the discount rate. I've seen a couple of base cases that are using as a net present value calculator a 5% discount, when I know that the companies, being non-investment grade themselves, if they don't have investment quality counterparties, are going to be facing a 15% cost of capital. So when you talk about the headline number in a base case, it's very important to know that a base case is just that. It's something that you yourself have to optimize.
Right. Okay. Well, we have 5 minutes left, Rick. So I want to sneak in nickel into this discussion to satisfy the contrarians in the audience. Nickel was in a very similar place that uranium is in today, at least in terms of being in favor, based on what was happening with battery metals about a year or so ago. And now there's been this new source of supply that seems to have completely flooded the markets and has driven nickel prices all the way down. When you think about development stage companies like Centaurus, where this price action in the nickel market is replicated in the share price action of Centaurus, how do you think about this in terms of staying invested or not in the underlying commodity business?
I love it. I mean, first of all, Aditya, as you know, I like world scale deposits, irrespective of commodities. I'd invest in a world scale sand and gravel deposit. I'm attracted to at least two, but probably three commodities, or four, as a consequence merely that people hate them. If you expand the nickel discussion to nickel, platinum, and palladium, I think that there are fairly common roots to the price decline, at least in the sense that all of nickel, platinum, and palladium share one important producer, Russia, which is dishoarding. We saw nickel, platinum, and palladium prices plunge in 1990 and 1991, the last time Russia was broke. Russia is selling everything that they can that has a bid in an effort to win the war in Ukraine and to keep their population fed. When the Russian shelves are empty, they emptied in 1993 before, the selling pressure on the commodity is relieved. In the course of nickel, the other supply addition was, of course, lateritic nickel deposits in the Philippines and in particular in Indonesia. I very recently flew over the lateritic nickel mines in southern Sulawesi in Indonesia, and I need to say that as the Indonesian citizenry begins to factor in the extraordinarily deleterious impact of lateritic nickel deposits being mined in Sulawesi, that the costs associated with laterite nickel deposits is going to increase. At the same time that the volume of new capacity additions from lateritic nickel will decrease. It's wonderful from a nickel investor's viewpoint to look at the incredible shutdowns that we're seeing in nickel production capacity, at least around sulfide nickel, particularly in Australia, which is to say that we are now at the point in the nickel price curve where we are, as a consequence of the pricing, absolutely obliterating supply. This supply obliteration, the obliteration of the means of production around primary nickel production, nickel sulfide production, means that as the Russian dishoarding ends as a consequence of having no inventory, and as the rate of increase associated with lateritic nickel production declines, that the increase in demand, which has been fostered by the low prices and the utilization of nickel, both in stainless steel applications, but also in battery and electric applications, means that a rebound is absolutely inevitable. So I, like you, am attracted to nickel precisely because it's a hated commodity. The same thing extends to platinum and palladium. The platinum and palladium prices have been falling like a boulder off a bridge. The headline reason for this fear has been investors saying that we're coming to the end of the catalytic converter, that we're coming to the end of internal combustion engines, which is ridiculously stupid. So from my point of view, continued demand for platinum and palladium as an auto catalyst through, say, the year 2060 is pretty much assured. On the supply side, the oversupply from Russia, I think, will come to an end at some point in time. And when I say some point in time, 12 to 18 months. And one must remember, with in particular platinum and palladium, that it's really produced in size only in Russia, South Africa, and Zimbabwe. There is a possibility, not a probability, but a possibility that internal political and social conditions in any of those three countries could materially impact the supply side of platinum and palladium. So I'm attracted to each of nickel, of platinum, and of palladium. I'm attracted as a speculator, Aditya, too, to the silver market, not because of silver supply demand fundamentals, but rather because of the extraordinarily low regard that speculative silver equities are held in. Those equities themselves had all kinds of adherents in 2020, 2021 during the Reddit silver squeeze. There is no one whose hate is quite as thorough as an unrequited lover. And the people who were disappointed in 20 and 21 wish they never learned to spell silver. Now that hate is reflected in the silver stocks, which traditionally have had more upside volatility than any other asset class in resources, with the sole exception of the uranium juniors. So I think that your question is very well founded. I'm attracted to nickel. We're early, but the prospects of a large sulfide nickel deposit in some country that wasn't Russia, Zimbabwe, or South Africa would be extremely attractive to me. Similarly, a very large nickel deposit would be of interest. A very large platinum and palladium deposit that wasn't in one of those countries would be very attracted to me. And I believe, given that I think that gold's positive momentum will continue, that silver ultimately will follow on. And I'm loving the very low regard that silver stocks are held in.